does Donald Trump and Haley Welch have in common? What is performing a pump and dump meme coin for 200? The apex of economics and finance. When I get to talk about this, and it actually is relevant. Also, this Wikipedia article, in one word, pretty hilarious. I always thought you had to do something profound or infamous to get on Wikipedia, but she found her own way, which is all we can ask for in this life. It's a funny read. So why am I even talking about these meme coins? It's a sign. Those red flags that we ignore because we got those rose-colored glasses on. In this case, our relationship with the economy. Instead of NFTs and FTX like in 2022, it's meme coins, AI, and quantum hype in 2025. Nothing has changed, just the cover. We get ads like these and stock moves like these, even though the news had nothing to do about the exact company. So what are some potential predictive signals for the market? Well, let's get into some popular ones. The inverted yield curve is when short-term interest rates are higher than long-term rates. It often signals a looming recession. We can go to the Federal Reserve Economic Data, or FRED for short, and see the 10-year Treasury minus the 2-year. In normal times, the 10-year rate should be higher than the 2-year because more time is seen as risky. But there are times where there's dynamic shifts causing the 2-year rate to be higher than the 10-year. This shift indicates investor concerns about future economic growth. If an investor thinks that the market may face a recession in 2 years, they may rather park their money in the 10-year. This increases demand in the 10-year, causing the yield or interest rate to drop while the bond price goes up. Bond prices and its respective yields have an inverse relationship because as the bond's price goes up, as more people buy that treasury, the bond's fixed interest payments is relative to the bond price. Therefore, the yield falls since the fixed payment is a smaller percentage of the new higher price. The yield curve has been inverted for 793 days, but now back in positive territory. However, many previous inverted readings were followed with a recession, making the inverted yield curve one of the most popular recession predictors. Next, transportation sector performance. When the market slows, businesses and consumers start to spend less on goods, causing less shipments, resulting in lower revenues for transportation stocks like logistics and trucking. This slowdown may reflect in the transportation stocks as negative news, quarter results, and poor sentiment causes a sector sell-off. This can then spill into the rest of the economy, enabling transportation sector performance to sometimes act like a recession or stock market drop predictor. We can look at some examples. In 2015, we saw a stagnant SPY while the transportation ETF XTN declined 12.8%. What followed was the 2015 flash crash, along with the overall global economic concerns like the Chinese yuan devaluing in value in August. The SPY dropped around 9% afterwards. Here's another one from 2018. We see XTN drop 3.8% while the SPY stayed stagnant. Then the S&P declined 9% in October 2018. Of course, no indicator is perfect. For example, COVID was a black swan event, so both ETFs dropped in March of 2020. At the end of 2021, we saw a divergence where the XTN was declining while the SPY was increasing. So what about today? The SPY has been flat going into 2025 with AI spending concerns and tariff scares. Simultaneously, we see the transportation ETF decline since the peak in December 2024. This could signal some downside for the S&P in the short term. Finally, we have the Buffett indicator, which takes the total US stock market value divided by the country's GDP. This indicator expresses the value of the US stock market in terms of the size of the US economy. If the stock market value is growing much faster than the actual economy, then it may be in a bubble, according to currentmarketvaluation.com. Currently, the market is 2 standard deviations above the historic trend line, suggesting that the stock market is foaming. Of course, there are plenty of other popular economic data points and indicators like housing, unemployment, jobs added, etc. When there's a peak, there's a valley. And right now, the view is beautiful. The S&P is up 80% in the past 5 years. So what may cause us to stumble? Maybe it's bird flu, geopolitical tensions, inflation and rising unemployment rates, or something else. I don't know. But instead of focusing on this mountain, perhaps there's a bigger one up ahead. We just have to keep moving forward. If we stumble upon a valley, I will treat it as a buying opportunity.